Okay, guys, hello and welcome to this presentation by KB Trading for the Future Online Conference. Now, the first thing I'd like you to do, if you can hear me and I'm coming through nice and clear, could you please just drop a message in the chat box? You can see my chat box on screen right now. There should be a little bit of a delay. I reckon there's probably about a 15-second delay between Zoom transmitting this to YouTube. So those of you on YouTube may have a slight delay. Yeah, so people are saying, yeah, perfect, loud and clear, awesome, fantastic. Okay, well, for those of you who are new or perhaps didn't hear me actually speak at the Edinburgh Uni lecture that I done in January, my name's Sam and I'm the co-founder of KB Trading Consultants, right? Now, the purpose of this presentation is to be an introduction to the financial markets. This is not aimed at your experts. This is not aimed at someone who has an in-depth, detailed understanding of the markets and how they work. This is more so aimed at somebody who's maybe dabbled with trading a little bit, maybe tried it out, heard of it, or perhaps it's something that you deem to be quite daunting. And today, hopefully, we're just going to break some stuff down and actually show you that trading isn't this daunting, scary thing that, is cloaked in mystery that only people on Wall Street or in the City of London can actually partake in. But it's actually something extremely accessible by people of all experience levels, almost all age groups, obviously providing that you are over the age of 18. But it's not actually this daunting, scary thing, and we're going to delve into that now. Now, first off, you may be looking at my screen and thinking, oh my goodness, what am I looking at? Don't worry, this is just the screen that you're being greeted with. This is not what we're actually going to be looking at today, right? So what I'm going to do is I'm going to take you over onto this screen, and hopefully you can now all see a very handsome cheetah, right? So if you can see my screen, you can see that cheetah. Just drop a message in the chat box and let me know that you can actually see that. Yeah, you can see it. Yeah, someone says the cheetah's looking good, right? Fair enough. Okay, so welcome to Trading the Financial Markets by KB Trading Consultants. Now, the reason there's a cheetah on screen, we're going to get onto that in just a second. Let's do it. Okay, so we're going to start off with a quote from a fantastic book. The book is Market Wizards, Interviews with Top Traders by Jack Schwager, right? I hope I've not butchered that second name. But the quote goes something like this. Although the cheetah is the fastest animal in the world and can catch any animal on the plains, it will wait until it is absolutely sure it can catch its prey. It may hide in the bush for a week, waiting for just the right moment. It will wait for a baby antelope, and not just any baby antelope, but preferably also one that is sick or lame. Only then, when there is no... Oh, someone's saying the audio's dropped out. Someone's saying the audio's dropped out. Has everyone got the audio? Okay, cool. Sorry, okay. Only then, when there is no chance it can lose its prey, does it attack. That to me is the epitome of professional trading. That seems somewhat mysterious way to approach trading, that kind of analogy. But hopefully throughout this presentation, you are going to begin to develop and to be able to identify with that professional mindset that Mark Weinstein has when he says this rather ambiguous quote about a cheetah hunting an antelope on the plains. So without further ado, let's get into the presentation. This is me, right? I don't have a webcam, so this is going to have to do. Just keep this image ingrained in your mind as we go through this, as you listen to my voice. Just imagine that this is the guy who you're talking to, right? So I'm the founder of KB Trading, right? We also have Callum. Callum's obviously not here. Callum is now the co-founder and works very closely with myself. So KB Trading stands for Kavanagh Barnwell Trading Consultant. My second name being Kavanagh and Callum's being Barnwell. Now, I'm a full-time trader, although I look like a child. I'm not, in fact. But I am an educator and a mentor as well as a full-time trader. And I've had 4.5 profitable years in the markets. Now, in total, I've been trading for around about 5.5 years now, 4.5 years profitable. And, you know, I will be the first to admit that when I say profitable, that does not mean consistently smashing it, you know, week in, week out, day in, day out. There are periods where it's just not going to be like that, but that is the reality of trading. Okay. So who is KB Trading and what do we do? On the right there, you've got a picture of me looking, you know, rather smug with my arms folded. And then you've got a picture of our Glasgow office with some of our traders on our trading floor. Now, who are we and what do we do? So we're full-time traders and analysts managing our own as well as some invested capital from our Glasgow office. We are also educators and we provide mentoring for beginners as well as experienced traders, right? So we educate beginners and mentor them to consistency. And even, you know, we do even encounter many experienced traders who are just treading water or perhaps struggling to gain consistency in the markets. And we're there to help them turn that around, okay? You wouldn't believe the amount of people who have a very developed understanding of how the markets work and they just struggle to gain that consistency. You know, I've been there myself, so I'm the perfect person to identify with those struggles, right? Now, we provide daily market insight and analysis to more than 1,000 traders worldwide via multiple platforms. We have a YouTube channel, we have Instagram accounts with upwards of 10,000 followers on one and 14,000 on the other. The YouTube channel has nearly 20,000 followers itself. So we really do put a lot of stuff out there, right? We have our Telegram groups where we, you know, mentor and educate clients on a daily basis. And we have a few hundred in there as well. And in the course of the company's lifetime, we have, you know, educated hundreds, if not thousands of people, both paid and unpaid, okay? So what is it that we actually trade, right? Well, we trade indices. So that's a stock index, DAX, the FTSE 100, the S&P. For those who may be unaware, the DAX 30 is a stock index of the top performing 30 German companies. The FTSE 100 is obviously the Financial Times Stock Exchange 100. You have the top UK performing companies on that stock index. And then the S&P, the Standard & Poor's 500, you have 500 of the top performing US companies on the US stock market, and that index trades them. So really, when we're looking at indices, we're looking at the strength. You know, it's a very good indicator for the, you know, the business sector within a country is these stock indexes. And what you'll find is that they often move in lockstep or in tandem with one another. So when I say they move in lockstep with one another, typically we find that these indices trend on a longer term with one another. And of course, the reason for that is because now, you know, companies are worldwide. They're doing business with, you know, countries all over the world. So, you know, if America is doing very well, for example, and buying lots of products from German companies, of course, the DAX is going to be doing well. And similarly with the S&P or the FTSE. So what you'll find is that all of our first world economies and countries prop up these indexes. So, you know, as we maybe slump into a bit of a recession, for example, you will start to see a little bit of an effect on indices, right? Now, what about Forex currency pairings? This is what the majority of our trading volume goes through, right? We're going to talk more specifically on FX shortly. So that's what I'm going to leave it there for just now and go straight on to commodities. So commodities, we could be looking at, for example, gold, or specifically gold traded against the dollar. Silver, again, silver traded against the dollar, or crude, known as crude oil, crude, WTI, traded against the dollar, right? Moving on. So for the purposes of this presentation, we do have that time constraint. We can't talk, all night. Not only that, but I don't want to bore you, right? So we're going to talk specifically about the FX and currency markets. So the Forex market, the foreign exchange, is a decentralized global market open from Sunday 10 p.m. UK time to Friday 10 p.m. UK time. Now, the FX currency market has the highest daily trading volume of any trading platform in the entire world, right? If you just scan your eyes over to the right there, you're going to see a figure that says 5 trillion, right? That is the daily trading volume of the FX market in 2016, right? Now, what you're actually going to find is that nowadays, this is nearly 6.5. Some even are estimating it at $7 trillion of daily trading volume per day. The FX market is so liquid. And why wouldn't it be? We're talking about the world's currencies being traded. If you look at that compared to the New York Stock Exchange at $22.4 billion, the Tokyo Stock Exchange at 18.9, and then the London Stock Exchange respectively at $7.2 billion daily trading volume. They absolutely pale in comparison with a cumulative trading volume of $86 billion versus estimated between 5 and 7 trillion. There is just no comparison here. So what actually makes these markets move? Who specifically makes these markets move? Well, these are known as market drivers, right? Now, the market is driven not just by one entity or, one group of entities, but rather a cumulative group of separate entities, right? We'll start off, see someone's accidentally drawn an annotation on there. Clear. 2 seconds, guys. What I'm going to do is I'm just going to turn off annotations, just so nobody has a mistake there. So let's look at these market drivers. First of all, we have the big banks. And in these big banks, we have 5 main big banks. We have Barclays, Citibank, Deutsche, JP Morgan, and UBS. Now, if you look at this chart to the right, any of you who are into finance, I'm sure most of you are, which is why you're here. But what we can see is the market share and ranking over a 10-year period of 2006 to 2016 of these banks' market share and ranking in the FX market, right? Let's just take a look at this for a second. You're going to notice up the top, you see Deutsche Bank trading there. That's that sort of yellow-orange color. Now, what I'd like to draw your attention to is in 2008, right? In fact, I can actually use my little laser pointer here. Technology is so handy. So 2008 for Deutsche Bank brings you in right around here, leagues above any other of these big banks, right? Absolute leagues above, with a 22%, just shy of a 22% market share and ranked number 1. Now, what you'll see is that in the aftermath of the 2008 financial crisis and the collapse of the housing market, Deutsche Bank slid its way down over a 10-year period to number 4 in 2016, finding itself below its counterparts that were trading at even less than 4% of a market share. So you can see it's absolutely slid off the face of the earth, right? Now, we're not here to talk about banks, leverage, and things like that, European versus American legislation. But what I will say, and hopefully just provoke a little bit of thought for you here, what I will say is that European banks historically have been known to over leverage, right? Have been known to over leverage, whilst US banks have been known to be a little bit more conservative when it comes to leverage. And if you look at legislation on trading securities in the US, you will note that leveraged options and stuff are seldom found in comparison to Europe, where leveraged securities are commonplace, right? And subsequently, you see the fall of, Deutsche Bank, primarily due to that, right? Now, again, I'm not here to speculate or to comment on Deutsche Bank's workings, but that's just something for you to know, okay? Now, So you have the big banks, you also have financial institutions and some private funds, so hedge funds and things like that. And then you also have the retail traders such as you and I. That's the small guys, right? The little guys that often get screwed. They comprise that figure of 85% of traders fail to make money in this game. Primarily, that's coming from these retail traders, the small accounts trading for personal profits, right? So what do we actually trade, right? Whenever I speak to stock traders or things like that, they say, I like the thought of the FX market. I like how liquid it is, but I don't like the thought that you're not actually buying or selling anything. And this is something that used to make me sort of pause and think, okay, I can see what you're saying, but this is something that I actually like about the FX market. The underlying value of the asset does not even matter. We are not trading the absolute value of the currency. We trade it directly against another currency in a little composition known as a currency pairing. Now, what we see here is a currency pairing. We see EUR representing euro against USD representing the dollar, right? The most traded FX pair is the euro USD, right? Now, in the example above, euro is known as the base currency and USD is known as the quote currency. So effectively, we are comparing one against the other. If the price of euro dollar is trading at 1.17165, that means 1 euro buys $1.17165. Now, I had initially intended to open up a chart and actually show you where euro dollar is trading right now. I might actually do that if you just bear with me 1 second. Because when I wrote this presentation, euro dollar perhaps wasn't trading. Yeah, so the price has changed slightly. So if we look at the chart of euro dollar here, you can see it's currently trading, which is represented by this little gray ticker here. Let's see if I can make this easier for you to see. There you go. It's currently trading at 1.17799, right, on this daily chart of the euro dollar. So the price has actually gone up slightly since I initially wrote this little presentation. Anyway, so when we're trading, we are betting effectively on the strength of one against the other, right? Or the weakness of one against the other, right? Now, how is it that we actually trade this, right? If we're not buying or selling a share or stock or anything physical, how do we actually trade it, right? Something that not a lot of traders even consider is, what am I actually trading? Well, you're trading most likely a contract for difference, also known as a CFD. Now, you may have heard this term thrown around and you may not have understood what it meant. So, memorize this and recite it back to the next broker who phones you, give him a nasty surprise. He'll know he's not dealing with someone who doesn't know what they're talking about, right? So a CFD offers a European trader an opportunity to profit from price movement without owning the underlying asset. It's a simple security calculated by the asset's movement between trade entry and exit, computing only price change without the consideration of the asset's underlying value. AKA, if you buy in at 1.14 and you get out at 1.15, your profit or loss is calculated on the difference between where you entered and where you exited. That may be a little bit confusing, but when we trade these contracts for difference, we'll trade in what's called lot sizes. So we maybe trade one lot contract or a 2 lot contract. Again, it's not fundamental that you understand that right now, but just know that when we're trading contracts for difference, right? So we are effectively, a contract for difference is that agreement that we're getting into that position and that our profit or loss will be calculated based on from where we get in to where we get out. If we buy and we get out at a higher price, the price has gone up, we make money, it goes down, we lose money. Similarly, if we sell short and price goes up, we lose money, or if it goes down, we make money, right? If I've lost anyone, please do not worry. It's not too important, right? So how can we actually make money? That is the most important part because as much as I love trading, you know, and as much as I would do it for a lot less than I currently make from it, we still need to make money. That's what we're doing here, right? So how do we actually make money? We know we're trading these contracts for difference. We know that the underlying value of the asset does not matter, but how are we going to make money from this? So we need to work out, if we're trading one currency against the other in a pairing, and we want to be able to predict where it's going, that's what we're making money off of, is our prediction, right? So how do we predict where price is going? Well, there are multiple strategies. Ours is what you would probably consider a 90-10 technical fundamental strategy. All this simply means is that 90% of our trade framing bias comes from a technical approach, which is what we physically see happening in the markets, chart patterns, etc., etc. The remaining 10% is based on macroeconomic factors affecting the market, such as GDP, unemployment, non-farm payrolls, these types of things, you know, interest rate cuts, statements, all of these different things that you may see on an economic calendar. Now, what I'm going to show you, we won't go into fundamentals too much, but I'll show you the economic calendar, and a free economic calendar that you can keep track of, you can look at in your spare time. And this is simply just called Forex Factory. And if you click on this calendar tab, you will see the upcoming announcements, the upcoming fundamentals, data releases for the days and weeks to come, right? Tomorrow, we have President Lagarde of the European Central Bank speaking, and we get a little orange icon to say that's medium impact. We then have FOMC meeting minutes later in that day coming out in the US dollar, and we can see that that's high impact. We also get projected data, you know, what actually comes out versus what's forecast, what previous was when we have data releases, and we factor this in. We never take trades based on this stuff, although many people do. Our strategy is short-term enough that we don't really need to be looking at the longer-term fundamentals of a currency, right? That being said, if something came out to suggest that the Australian dollar, you know, or Australia is going into a recession, we might look to get involved in that downtrend over the coming months, but on a shorter time frame. Okay, so the reason that these forecasted figures, the actual figures and stuff are very important is if price falls in line as it did here. So we had a rate statement from the Australian dollar at 4:30 a.m. right, from Australia. What we see is that previous was 0.25%, forecast was 0.25%, and actual was 0.25%. So effectively, there was no change from what was really expected. And therefore, we don't expect like a huge reaction from something like that, especially if it falls in line with current and previous forecasts, right? Now, if we just track back one, we can see we had services PMI come out in the US. That was previous 56.9, forecast 56.3, and the actual came out at 57.8. Now, that's in green text simply to show that it's come out greater than forecast. That's typically going to be good for the currency. And being that it's high impact and that the market's anticipating it, you can often see a relatively bullish or favorable reaction in favor of the dollar off the back of news like that. Now, someone said, what's the difference between investing.com and Forex Factory? It really comes up down to preference. Personally, I use this, which is just a portal that's provided with the brokerage I use, right? So I have money deposited with this brokerage that I trade on a daily basis, and I get all of my announcements and stuff like that provided for me here, right? So I have this portal open. I actually currently sit in front of 4 screens, right? So I have that just sitting on one of my screens for the majority of the day, and I keep an eye on that, okay? Yeah, just looking at some of these questions, fair enough. Okay, we'll get onto the actual Q&A section at the end, right? Now, of course, as stated, these fundamentals rather only comprise 10% of my strategy, right? I take them into consideration. I will never enter a trade, on US dollar if we have high impact US dollar news coming out in a couple of minutes or anything like that. I like to play things on the safe side in that regard. But 90% of the approach comes from technical analysis. So what is technical analysis? Well, technical analysis is simply analyzing currency charts and market behavior, price patterns, etc., that we deem to be a reliable indication of where price could be going. Now, this word could in here is extremely important, right? We are never saying that price is definitely going somewhere. You have to have that mindset of price could go there, and we're using something that we deem to be reliable, a reliable indication to determine where price is going. So effectively, we're looking at things we know work to see how strong or weak price is. Now, how do we know if something is reliable? Well, I would encourage you to think in your personal life, right? How often have you been let down by somebody who you trusted, right? Or met someone and, perhaps thought, this person could be a really good friend or whatever. You arrange to go out for a drink with them, and 10 minutes in, you realize that you have absolutely nothing in common, and you can't be bothered talking to them or sitting with them the rest of the night, right? You'd rather be anywhere but there. Well, this is human nature, right? And you're not silly or stupid or anything like that for feeling that way, or occasionally making mistakes with things you deem to be a reliable perception of someone, right? Because that's human nature. Humans are naturally very trusting creatures. That is something that's not very good as a transferable skill in trading. And this is a pattern that you will find as you start to delve into trading, that all of the things, the attributes, the emotions, that trust, it's not transferable into trading in any way, right? So how do we know if a system, a market pattern, behavior, etc., how do we know if that's a reliable indication of where price could be going? Well, quite simply, we test it over a decent sample size, and that is 90% of a trader's job, is to find a pattern or an indicator or something like that, develop a system, and to test it ruthlessly. Now, when I say ruthlessly, I mean taking 30 positions over a period of time, over a period of a couple of years on multiple assets. So trading it in commodities, trading it in indices, FX pairs, FX majors, FX minors, FX cross pairs, in order to determine whether this is something that is going to be a reliable tool to help us predict where the price could be going, right? So we use a decent sample size. Now, herein lies the issue with many traders, right? They deem something to be reliable after observing it working not 30 times, just a handful of times, right? This is known as a recency bias. A recency bias, now you can look this up for I'm not a dictionary, but a recency bias, in my understanding, is the belief that something is going to work or should work just because it has previously, more so recently, right? Now let's look at an example of some technical analysis and really kind of discuss the technicals that we use and a little bit of an example of how they might work. We don't have time to go, absolutely plunge into, hundreds of different trading examples. For any of you who are members or know me or are maybe part of my community, you'll see us do this sort of stuff on a daily basis, but we're going to break it down. Here we have a D1 chart of the pound against the Japanese yen. Now, D1 simply stands for daily one, and it means that each one of these little bars here represents 1 day of price movement. On this green bar, price opened down here, it closed up here, right? On this red bar up here, price opens at the top and it closes at the bottom, right? You get these little wicks in either direction, which show that price traveled in one direction and was pushed back down and then closed lower, right? So that's what we're seeing up here, right? Is price just failing up there. So to someone who doesn't have a technical approach, They may just see a currency chart. They may see, you know, prices in a downtrend here. It started up here, it's trading down. It looks like it's going down the way, right? And, you know, you are right in a sense. On some time frames, this may be going down. But what does a technical analyst see? Let's take a look. Now, some of you may be thinking, yeah, cool, I'm used to seeing that. Some of you may be thinking, whoa, what am I looking at here, right? We've applied some basic technical tools. Now, it's not my job here to teach you how to become a technical trader in the next, you know, 10, 15 minutes. But what I am going to talk to you about is how we would apply these technicals, right? So this orange line that you see in here represents this high back here. We deem this to be a point of resistance. We can see the price tried to push up and stopped at that level before pulling back. Now, often when something breaks like that, you know, a resistance level breaks, it becomes support, meaning that when price breaks and hits it on the other side, we'll find some support there, and it can often use this as a base to move off. Let's look up here, this orange line that we've got drawn in here at 141742. Well, going back, you can see price pause there before it eventually breaks through. It comes up, it pauses, pulls back, breaks, it then sits on it and finds some support here. It breaks, it trades above, it breaks back below, and then retests it as resistance. And price puts in this big wick here, showing very strong rejection from that level from underneath. So this gives us a little clue that that level could be relatively strong. And this level down here, again, we get this inclination that it could be strong because we've paused there, we break, we pause on it again, puts in a significant push up. Now, that alone isn't really the best thing to take, right? You can't just take one, you know, technical tool like that. We like to have a couple, you know, 2 or 3. And so we have a Fibonacci tool, which is this little tool. You can see the levels, they're multicolored there. Anybody who knows the Fibonacci sequence, you know, 1, 1, 2, 3, etc., 5, whatever, you know, again, I'm not here to teach you maths, but you'll know that the Fibonacci sequence has that golden ratio that relates the numbers, right? And it's that 61.8, right? Or the 0.618. So on the Fibonacci retracement tool, we have different Fibonacci ratios that price can often pull back to and find support or resistance on before continuing its move. Now, let's look at some evidence of this. We take the Fibonacci tool from the bottom to the top. As it pulls back, look at the way price just stops and pauses on that 38.2% Fibonacci level. It breaks and it retests it. It finds resistance where it found support. It trades down, it stops on the 50% there, trades up, and then draws down towards the 61.8. Now, although these Fibonacci retracement percentages aren't perfectly on this level, we do have some confluence in that area of those Fibonacci levels, right? Now, the more interesting thing is that the Fibonacci extension up here, which is the minus 61.8, lies right on this strong level that we determined before. That frames a nice trade idea where we can say, okay, well, we'd like to buy in here and we'd like to aim for here, right? Relatively simple. And of course, it happens, right? Price trades up, it trades up towards that Fibonacci target, hits it, you know, pulls back from it, and then trades along sideways before eventually going up to meet that overall level, right? Just like clockwork. Now, some of you may be thinking, why, right? You've drawn some lines on a chart. Why would that even work? And you can't be blamed for thinking that. After all, I have just drawn some multicolored lines on a chart and made money from it. I mean, what's like, you know, you can't be blamed for thinking like that. So the simple answer as to why this works is human psychology. What specifically about human psychology? Well, one, people are predictable. 2, people repeat their actions. And 3rd is that people react to things in a consistent manner. Now, this one is the most important, right? Let's think about the recency bias again. If people react to things in a consistent manner, that's where the recency bias comes in. Now, you may be thinking, whoa, people don't react to things in a consistent manner. You know, one day, you know, my girlfriend's crying, the next day she's laughing. People react to things in all sorts of manners, right? Well, I would agree with you in some senses, but let's actually just think about this, right? Do you know anyone who consistently gets road rage? Do you know anyone who consistently cries at movies? Or do you know anyone who perhaps likes slapstick comedy? Now, it may seem a bit daft, right? You may think, well, you know, that's a fairly broad spectrum. Think about specific people. I'm going to give you a moment to think into your head. Do you have somebody in your life, perhaps a parent or, you know, a boyfriend, girlfriend, who anytime you're in the car with them and you hit traffic, you think, man, they're going to kick off. And sure enough, they do. Or you sit down for a movie with them and, you know, 10 minutes in, they're crying and you think, come on, it's only Monsters, Inc. It's not, you know, it's not a big deal. But they're consistently getting emotional at movies, you know. Or perhaps somebody who, you know, you go to watch a movie and they're always suggesting something, you know, a little bit more slapstick, whatever it may be. But they like that particular thing, right? And this is where we have that, let's go back to that previous slide, the reacting to things in a consistent manner, the consistency in their actions, their reactions, their emotional response. Let's break this down. What is road rage? Well, it's someone reacting to traffic, right? Someone who hates traffic. What is, you know, crying at movies? What is that? Well, it's somebody who consistently reacts emotionally to stories. What about someone who likes slapstick comedy? Well, in my opinion, they're just someone who finds pain funny, and you ought to be careful around those kind of people, right? But all jokes aside, let's try and relate this back into trading. We've taken a little, you know, we've went astray a little bit from the trading chat and we're starting to become, you know, a psychology lesson. So let's relate this back. Now, we've spoken about the market drivers. We've spoken about the emotions, the emotive responses and things like that. Who are the market participants? Who are they really? Now, we know that there's hedge funds and institutions. We know that there's retail traders. But really, in its simplest form, we have humans trading and we have algorithms trading on behalf of humans, right? So a human thinks and acts based on emotional responses. They have a fairly repetitive behavior. And this is where that consistency in, you know, their actions and their reactions comes in. They are dumb money, right? In the trading industry, retail traders, humans, they are the dumb money, right? They are the ones who are repetitively doing the same things, making the same mistakes, acting the same way, and they're paying my wages, right? This is the dumb money. What about the algos? Well, they act on input systems or data created by professional traders or software developers. They know how the humans act, right? How do they know how the humans act? Because they've been programmed to do so. And they also act and react quickly. Now, somewhere in between this human and the algo, you have what looks like a cyborg, right? But is actually a professional trader or someone who trades for a living profitably, consistently, and successfully. They are somewhat of a hybrid between the two. That's not to say that I'm part Android, although I wish I was, but they have a system that they have input into themselves. They have a developed understanding through research and statistic gathering, and a system that if a trade does not meet that criteria, they cannot physically bring themselves to take it, right? Or they don't allow themselves to take it. So they have that sort of Android-like robotic approach. Now, they also know how the human acts because they are a human, right? And they act and react quickly, just as the algo does. Maybe not as quick, maybe not anywhere near as quick, but they still act quickly. But on the same stroke, they do still think and act based on emotional responses. They filter it out as much as possible because it can affect their profitability, but they do still have an aspect of that. They also have or can suffer from repetitive behavior. However, they're not quite the dumb money, right? Because they may go through short periods of making mistakes, thinking and acting emotionally, or having some repetitive behavior, but they loop back to this. They have that system, they have the data, and they can stick to it. They may go through periods of this because they're human, right? And they make mistakes, but they have that ability to realize when they're doing something wrong. They're extremely self-critical, and that is how you need to be as a trader. Now let's bring this back to how technical analysis actually works, right? You may be thinking, oh man, you're going on a tangent here. You've got these Android type, full-time traders. You've got the algos for humans. What are they all doing? They're all acting and reacting based on certain things they perceive on the charts. The reason technical analysis works at all is because it's self-fulfilling, right? It works because everyone is acting or making decisions at these levels in the markets, whether it's trend lines, exponential moving average crossovers, whatever it is, Bollinger Bands, fib ratios, etc., etc. You have all of these people, entities, algos, humans, professional traders acting and reacting at specific areas, which creates liquidity and allows the market to move. On the one hand, we have humans making decisions at these areas. And on the other hand, we have algos reacting to the data on the charts that they've been programmed to react to. What we end up with is patterns that have a predictable outcome. Let's look at a super simple example. Now, we could go so complex on this, but we just do not have the time, right? Here we're looking at a chart of the pound yen, and again, we're on the daily. You can tell I like the pound yen, right? Now we have one of these support levels where price is paused, we've smashed straight through. And as we trade back up, if price encounters that level, have a think to yourself, what might happen? It stopped here. Could it stop again? In fact, it does. And not only does it stop, you see that wick rejection. Remember that rejection, that long wick at the top. This long wick at the bottom shows rejection at that level. Price tried to push down and was forced back up. Price tried to force up and was pushed back down. And then we see that significant sell-off. Okay. Now, what happens if price comes up to it again? What happened here? What happened here, right? If price comes up to again, maybe it'll stop again. Not only does it stop to the very point, but it actually trades off, sells off again. Third time lucky. Is it going to do it again? Well, you may think, yeah, okay, you're going to get in there again. And what's happening here is we're getting a repeating pattern. And the retail traders, the dumb money, they are also repeating what they're doing. The professional is sitting aside, right? He's sitting aside and waiting. Dumb money got in here and sold. They made some money there. They get in here and sell. They make some money there. They get in here again and sell and make some money there. And they say, this level cannot be broken. If it gets up there again, man, I'm going to go short big time. All of the money that I've made on this last 3 trades, I'm going to stake that because it's a sure thing. It's just happened 3 times in a row. And so what is the dumb money thinking here? That's what they're thinking. Now, this is a rather odd black and white image of a man screaming into a phone. And I'm not even sure it's trading related, but I found it on Google and I thought it was hilarious, right? It sort of looks like Richard Hammond, actually, doesn't he? Yeah. Okay. So they're thinking about going short again, right? The dumb money. They've done it 3 times. Let's say they've made, 200 quid. They think this time I'm going to risk 400 and I'm going to make a killing. Now, I don't think you need me to tell you what happens next. That does. What went wrong? It worked here. It worked here. It worked here. Surely it was going to work again. And so this is the fate, typically, of your dumb money traders, right? They see something happen so many times, they develop a recency bias, and they gain that false sense of security. And when it comes back up there, they hit it short and they lose money. Now, if you remember, I told you the professional trader sits out, right? And what does he think? Well, he knows, because he's done his homework, that the third touch on a level is the highest probability of a bounce. And he knows that the fourth touch is a 50-50 probability of a bounce or a break. So what does he do is he also knows what the dumb money's thinking, so he buys in. And in this short move here, he hoovers up all of the money that the dumb money's made here, right? They've made a few hundred. And when they lose, they may as well bank transfer to smart money. They may as well bank transfer all the profits, because that's all they've done. They've made a few hundred here and they lose it all to the bigger trader who comes in, uses their sell side liquidity and mops it up, right? And this can be simplified with a quote. A good poker player plays the table. A great poker player plays the person sitting in front of him. That's a bit of a tongue twister, isn't it? A good poker player plays the table. A great poker player plays the person sitting across from him. Yeah. Well, in trading, this is one of my quotes that I say to a lot of people, but a great trader must understand how the majority think without thinking how the majority think. I'll just let you think about that for a sec. Now, I'm not going to bore you with any more of this nitty-gritty stuff. Right? We've done enough. We've spoken about a little bit about analysis, and we just don't have time to go any further, really. But what we will talk about now is what is more important than analysis, and that is the management of risk. Whatever approach you take to the markets, it could be purely fundamental, it could be purely technical, it could be a mixture of both. You're a speculator and you're here to make money, but you cannot control the market. In fact, the only thing you can control is how much you risk, aka how much you lose when you're wrong. And you have to have a pessimistic mindset of assuming you are going to be wrong a whole lot, right? Because if you don't, you ain't going to be prepared for it. And when you do lose, it's going to hurt. Trading is a game of probabilities, right? Meaning the outcome of a trade is not certain or guaranteed, much like a game of roulette. With that being said, if roulette was a complete gamble, could the casino consistently make money? Well, the answer is, of course, no. So the casino must have something in place that allows them to make money. And this brings us on to the trade like a casino principle, right? By Richard L. Weissman. Richard L. Weissman published a book titled Trade Like a Casino in 2011, where he first authored what I describe as the casino's edge. And this is simply the fact that the casino has an edge on the roulette table that the players are almost unaware of, right? It is effectively the sleeping giant, right? On the roulette wheel, there are 18 red numbers and 18 black. So you'd think that in such a game, the odds are 50-50 in either party's favor, the house or the player. If there are only 36 slots, this may be true. But on the roulette table, there are not 36 slots. There are in fact 38. We have our 18 red and 18 black. We have 1 green 0 at the bottom and 1 green 00 at the top. So when a player bets on red or black, instead of the odds being 18 out of 36, aka a 50% chance of it going either way, they're actually tipped in the casino's favor by 6%, right? So you actually have 18 over 38, which is a 47% chance of winning. The casino having a 6% edge means that in every 100 million bet in the casino, they walk away with 6 million profit, all from a game that effectively looks like it's 50-50 odds. Interesting, right? So how do we apply this into our trading? This is the important part when it comes to being profitable. How are we going to apply this into our trading? risk versus reward. The simplest way to gain an edge over the markets is to skew your risk to reward in favor of the reward side, so that over a batch of trades, your risk is a consistent fixed numerical value and your reward is consistently bigger than your risk, right? Over a batch of trades, we should in theory be in profit if that is the case. So in this first example, we're going to look at risking 1% to make a 1% return. So the risk to reward is 1 to 1, and we'll assume that we're trading with £50,000. Here we look at a trade, irrespective of any analysis, we say our target is £500 reward and our risk is £500 loss. This trade unfortunately loses and we lose £500. We're going to take 10 trades. You know, we take 5 losses and then we take 5 winners. We win £500. Now, with a strike rate of 50%, meaning you win 50% of your trades, over 10 trades, you take 5 losses and 5 wins, you break even. You make 2,500, you lose 2,500 with a risk to reward of 1 to 1. Now, if your strike rate was to dip to 30%, which means you lose 7 out of 10 trades and win 3, again, you lose your £500 there and you win your £500 there. So you lose 7 at £500 loss per time, which is a loss of 3,500, and you win 3 at £500 per win for a win of 1,500. Your overall result is negative £2,000 on that account. Okay. So how can we be profitable with even a strike rate as low as 30%? Meaning that out of every 100 trades, we only win 30. Out of every 10 trades, we're wrong 7 times. How could we be profitable in such, with such poor results? Let's change the risk versus reward ratio to 1 to 3. This simply means that our risk per trade should be 500 and our reward, we're going to shoot for 1,500 now. Let's look at similar trades. Again, we lose 500 on this trade. On this trade, we make 1,500, okay? So let's look at that with a strike rate of 30% again. We lose 7 trades, right? And we win 3. What do the numbers look like? Well, you'll see that on those 3 that we win, we actually engulf the losses by £1,000. So even though we're wrong 70% of the time there, because of our risk to reward and because we're making 3 times the amount when we're right than we lose when we're wrong, we actually end up overall up. Not a lot, £1,000, right? But we're still up. What about with a 50% strike rate now? Again, we lose 5 and we lose 500 per time. We win 5, we make 1,500 per time. The losses amount to £2,500 loss and the wins amount to £7,500 gain. Overall, we are up 10%, right? Even winning only 50% of the time, much like the casino, that sort of 50-50 odds it looks like, we're still in the green. And we're not just in the green. We are taking home over 10 trades, 10%. That is far higher for those of you who know anything about interest rates. I'm sure most of you do. That is far higher than what you would gain in many years of your savings in a bank, just over 10 trades, even losing 50% of the time, just tweaking that risk to reward ratio. So in tonight's presentation, I've touched on some of the basic principles of trading, right? Spoken a little bit about how we manage risk. I've showed you some basic chart analysis, but I also mentioned at the start that we are in fact educators. We do provide education and we help traders on their journey, right? So I'm going to briefly run you through how we provide service to clients, right? How we help people find consistency in the markets. Whether you're a beginner, you've never traded before, or whether you are a trader who's already been trading a little while and just struggling to find consistency, we have something for everyone. Now, one of our products that we offer is a monthly membership at £50 per month. With this membership, you get access to a trades and analysis chat group. where each day we share promising trade setups and analysis for the day ahead, as well as useful market information. And every Saturday we meet for a live market breakdown and Q&A session. We also have a community group where you can chat to our other members, both experienced and aspiring traders, and share ideas and socialize with other like-minded traders. This is really going to help you learn from people who have been in your situation, right? Been in your position. We also do a Task Tuesday. Every Tuesday, I give out some homework. That could be data gathering, research, whatever, with the purpose of helping you develop your trading skill set. We do a workshop every Wednesday, where each Wednesday I break down a trading principle or technique on the TradingView platform, which is a free trading platform. We then demonstrate how to apply it in the live markets. Most of this is done for our members on demonstration accounts, meaning they never actually risk any of their own money whilst they're learning, right? Now that membership is £50 per month, and you get all of that you can see on screen there. Now, our second and perhaps our most popular product that we offer is in fact our online course, right? Now, our online course gives you access free for life to everything that comes with the monthly membership, as well as a 140-page PDF document handbook with everything you need to know, from the basics to the more advanced trading principles, techniques, and strategies that we use. And it also comes with 5 one-to-one Zoom mentoring sessions with myself. We will chat as often as you need to go over things, go over course content, etc., to really help you develop your trading. And it also comes with that guidance and coaching, that continual support. Now, at the moment, we're doing 20% off that. So it's $319 for that lifetime membership, as well as the full course. Now, if you do want to check that out, find out a bit more about us, keep in touch, or actually get involved in the community, you can find that at www.kb-trading-consultants.com. Or if you type KB Trading into Google, you should be able to find us. You know, we should come up near the top. Now, we've actually got time to do roughly 10 minutes of questions. We started at about 10 past, so we do have 10 minutes to just go over some questions. So what I'd like to do is invite you to use the chat box either on YouTube or on Zoom, and just let me know what you're thinking, you know, what are your questions? Let's see if we've got any coming through. I'm going to give you sort of a couple of minutes to type out any questions you may have. Unfortunately, I can't open the mic up for everyone, as it could just end up, you know, a real mess with everyone just trying to talk over each other. Someone said, how to avoid entering a trade early. Okay, so what I would say is, in order to avoid entering a trade early, when you actually sit down in front of the markets at the start of your trading day, have an idea of what you'd like to trade for the day. Write it down, okay? Write down in an Excel spreadsheet. In fact, I may just open up my own Excel spreadsheet and show you. Write down in an Excel spreadsheet what you're looking to trade for the day. So something like this, right? This is actually, there's a trader, famous trader called Tom Dante. He is one of the first people who encouraged me to start doing this. But to have a spreadsheet or a plan of everything you'd like to trade for the day and write out where you'd like to trade it from. What you'll find is that throughout the day, if you don't have something in your plan that you want to enter, or prices perhaps, you know, not at the level you want to enter, it'll be much easier to manage those emotions that are provoking you to enter that trade early, right? If you've got it in writing that you need to enter at a specific level. So that is what I find helps me. Someone said, did you join any trading groups when you were starting out? I tried a couple of sort of signals groups, I believe. I don't know what names they go by now, but they effectively send you trades and tell you where to buy, where to sell, and that type of stuff. And, you know, I lost a lot of money following these guys who were effectively just selling a lifestyle. And, you know, it sucks that I never had a community like the KB trading community that we run when I began. But in some aspects, I think if I did have a community, I may never have started my own. You know, KB trading was started in response to these kind of issues, right? The issues with, you know, these scammers and stuff like that in industry. We thought we'll start our own community and we'll actually help people, you know, by teaching them what we know. So I didn't actually have any decent trading groups when I started out, unfortunately. But I think, you know, it really speeds up your process. It took me well over a year to even start to gain some consistent profitability. Whereas we have members, you know, 2-3 months in already going to get invested accounts and funded accounts with prop firms online, and, you know, making serious money that I you know, never did in my first few months. If I purchase a funded trading course, will I receive the £50 monthly membership with it? Yes. So, yeah, as shown in the presentation, you do absolutely receive everything. I mean, if I just bring this on screen and click online course there, you will see also included with the course is everything here to the left, right? Trades and analysis group, community group, Task Tuesday, weekly workshop. You've got everything, right? Everything, and then your full course content's there too. Right. This is our website, by the way, for anyone who's interested. We're getting a new one built at the moment. You can see some team photos, who we are, and, you know, our address, where we are, phone numbers, everything, you know, so we're very, very transparent. But yeah, so everything does come with that funded trader course. Now, I keep cutting profitable trades too short because I'm worrying for pullback to entry. What I would say to you, Mark, is that price pulling back to entry is, you know, it's not an issue. It really isn't an issue because price will often fluctuate before it makes a directional move. I mean, let's just consider this. For example, if you'd got short from this candle in here, let me grab in my annotations here. If you'd got short, perhaps, say this candle in here, price pulls back up here, we actually get a full pullback right there. You know, before it actually makes its directional move. It's certainly not an uncommon thing. Again, if you maybe entered on this bearish candle here, price pulls back multiple times before making a directional move. The only way you're going to gain that kind of confidence is to know that you've got a specific target that you're aiming for, that you've, you know, perhaps found on a daily time frame. You're looking to run it up to the next area of support or resistance, and you have conviction in that target. And unfortunately, you're going to struggle to find profitability if you can't commit to a trade, you know. So I would say don't cut profitable trades short. If anything, let profitable trades run, right? That's the important thing, is let your winners run and cut your losers early. You know, it's the very basic principles of trading. The first 3 steps in applying technical analysis to a new chart. Start on the weekly, look for areas of structure, try to formulate an idea of where price could be going. Drop down onto the daily, same thing again. Where's price going? If price is going up, how am I going to get involved in that up move? You know, it really is as simple as that. It's just a matter of seeing prices closed up through a level and then getting long in line with that bias, or, you know, whatever it could be. I was personally in a trade on the DAX earlier today. I got in right around here where this little white dotted line is, and I perceived price could be running up on that prior high there. Then, you know, as I dropped down onto the lower time frame, I've got my white line in here. This is where I entered. Price traded up towards my target throughout the day. Last night, I woke up in the morning, I moved my stop loss to under this wick here. Price traded down, took me out before moving to target. That's one for the journal, right, that I'm going to learn a bit from. I think I made £200 on the trade rather than the, you know, £1,000 target that I had, just over £1,000. So, you know, but what you have is that higher time frame idea that price is going to go to a certain point. And when you drop down onto the lower time frames, these little fluctuations in price shouldn't shake you out. You know, you shouldn't really be getting worried about small fluctuations in price. Someone said, when you're starting out, how did you manage to control your emotions when you're in drawdown? I would say if drawdown is causing you to be emotional, you're risking too much or you're not comfortable with your risk. It's very, very important that you accept that your money is gone before you lose it. Now, what do I mean by that? Well, I often say to the guys, you know, the traders on our trading floor, if I gave you £1,000 and said, okay, go and invest that in a stock, it would take you more than a month because you actually have to physically pay up front for that stock. You have to buy those shares. Whereas, you know, you have £1,000 in your trading account, £1,000 is maybe 1% of your trading balance. You're happy to risk that multiple times over the month, right? Because you don't have to pay it up straight away, it's very easy for people to get complacent and not actually realize what they're risking. So predefine your risk at trade outset, work out what 1% of your, you know, your account balance is, and that's how much you should risk. And, you know, if 1% is still causing you to be emotional, then drop to 0.5%. But, you know, you have to be comfortable losing money in this game. You know, learn to love it. Learn to love losing money is the way to deal with drawdown, because in every loss is a lesson. And I learned so much more from my losers than I do from my winners. Someone said, would you say you can become consistently profitable within a year then with the right help? Oh, of course you can. Of course you can. I mean, we have, if I just go on to, I don't want to flex our Trustpilot in anyone's face, but we have members who have literally, you know, within months. I mean, you can read some of our reviews here, but Emil Burris is somebody who's actually passed his FTMO challenge. You know, you can see overall we've got, I think, 4.6, 4.7 stars. But Emil Burris is actually now trading a funded FTMO account just, you know, after 3 to 4 months of trading in the group and receiving education. And, you know, it's really good to see members smashing it, but it's absolutely, you could be profitable within a year with the right help. Not saying you're going to be making millions, guys, you know, I'll be the first to admit that to you. I'm not making millions out here. You know, I average sort of £4,000 or £5,000 a month, which, you know, to some of you may be, wow, you know, mouth wide open, you know, but, you know, I'm still relatively young. I know traders who are doing 10 times that in a week. So again, you know, you're not going to be making millions within a year, but I sure can show you how I got profitable and help you on your road to profitability as well. And that I can guarantee you. How can you say early the market is going against your trade? I mean, what you need to establish is the structure of the market. Is it just a pullback or is it actually selling off? And I'm going to take you back onto this DAX trade here, right? So in this example, we can see the market pushes up, it pulls back, it breaks structure to the upside. See, it breaks through all these highs over to the left, it pulls back. You know it's just going to resume its uptrend. Now, I was happy to run the trade into this target, which was this high here. However, the reason I was initially targeting this high in here is because I'm not so sure that the market isn't just going to turn from here. So I like to get out where I'm sure the market is going to go to. I'm not sure it's going to go past there. I'll get out at the area that I know it's going to go to. Now, in this kind of area where price is stalling, there is a good chance it could start to turn against your trade. If you bought in from here, what I'd be doing is I'd be drawing in some structure like that, right? Some support / resistance. And when price pulls back into it and starts to do that, I would think this is just going to start to tumble down and down, and eventually it's going to take out your trade, right? So it's all about observing the market structure and seeing if the market structure is actually shifting the momentum or if it's just a small pullback. If you're still creating higher highs and higher lows, you're in an uptrend. As soon as you start to break those lows, you know, maybe the market sentiment's changing. Yeah, Andrew Norton saying, William, of course you can. Just remember risk management, mate. Thanks for that, Andrew, mate. Hey, Sam, how many pairs do you analyze per day? So I analyze the pairs that you see on screen. We have 9 FX pairs. We have 2 stock indexes, and we have crude oil being the only commodity that I currently trade. It's normal over risking. Just want to gather yourself a trading plan, stay consistent to it. Very good advice here, Andrew. Great seminar, Sam. Really enjoyed it. Really good to strip back to the basics. Oh, thanks for that, Robert. Mark saying he's joining the team. Really looking forward to that, Mark. It'll be good to have you on board. Someone said, after joining your course, will you show us your setup? Will you show us your setup? Absolutely. Yeah, I mean, of course, we will show you everything. We'll show you everything you need to know. You know, that's what we're here for. Someone said, in the £50 membership, do we receive a video about technicals? You will receive daily, almost daily videos, right? Almost daily videos on the markets and what I'm looking at, and you will gain, you'll get a weekly video as well. If you want more videos, more information, then the course is the best way to go. And it's a very good value for money option as well, guys, because it's only £320 at the moment, and you get lifetime membership as well as the course. So, you know, it makes sense, right? That offer is only on until Friday for those asking in YouTube. Have you ever considered a job in investment banking? Not really, to be honest. I like not really having a boss, right? I like that kind of aspect. I've always been entrepreneurial, and I've always liked that kind of freedom. Do we get to have one-to-ones with you as many times as we want? So with the course, you get 5 free one-to-ones, and then there's £60 after that. But 5 hours of one-to-one calls with me is absolutely sufficient to get you on the road to profitability. I would say check out the YouTube channel. There's some analysis videos on there. Yeah, I can open that. This is going to be like, what's it called? Inception. It's going to be like webinar Inception, because you can see the webinar within the webinar. But let me open up my YouTube over here. So you have your channel. So this is the YouTube channel. There's lots of videos. We do day in the life type things. We do £100 challenge. We do even some tips and stuff like that. You know, so there's loads of stuff in there that you hopefully will find useful. Okay. Where can I move that tab over? Someone's saying, when's the next $100 challenge out? I've actually not traded on the $100 account at all. Not for any specific reason. I've not fallen out with it or anything like that, but I've just not seen anything that I'd be overly comfortable taking on the £100 account. You know, we do have to apply a different style of risk management to that. It's very important that we don't just treat it like it is, you know, any other account. We have to be very careful with it. So I'm only taking the very best setups, guys. We'll do one or two last questions. Binge date episodes today. That's it. Good to hear it. Someone said, would you use a take profit or a trade on stop loss? I use both. Okay. What's your current strategy? My current strategy is effectively a break and retest. I trade, or I analyze the daily, weekly, 4 hour and 1 hour, and then I execute on the 1 hour. On the app Stinu, does it have default leverage? Because I see on the settings there is no leverage stuff, or it works with all leverages. In my experience, it works with all leverages. Yeah. Love the new wrap on the car. Beautiful stuff. Thanks, guys. Okay, guys. Well, I'm going to leave it there for tonight. I hope you really enjoyed this webinar. I certainly enjoyed it, and hopefully in the future, pardon the pun, we can get a few more of them. Okay. So. Perfect. So, okay, cool. So guys, that's it. Thank you very much for watching. If you do want to join the KB trading community, the link is there. It's just kb-trading-consultants.com, or of course you can just type in KB Trading Consultants into Google and you should find it. But thanks for that, guys. I really enjoyed it. Take care.
Hey Sam, how are you doing?
How's it going?
Thank you so much for coming today. It was a real pleasure to have you. I was watching the majority of the. I think I came in 5 minutes late. There was a bit of an issue, so one of us was supposed to help you with the moderation of the questions and the tech support, but there was a bit of a mix-up with who was doing that. So sorry I was a couple minutes late, but you seem to have already started and gotten into stride. I hope you didn't face any issues.
No, it was fantastic. At first I was thinking, oh, how do I get the YouTube?
Actually, just one thing. Sorry, just one thing. Can you end the live stream? So if you click on the more and then click